Can a single ordinary employee bring down one of the oldest and most respected banks in the world? At first glance, it seems impossible. Major financial institutions are built over decades, even centuries. They survive wars, crises, and political upheavals. They are protected by control systems, audits, complex regulations, and vast management structures. It seems that one person simply cannot bring down a machine like that. But history has shown otherwise. This is the story of a bank that had existed for more than 230 years. A bank whose history began in the 18th century, when Europe was only beginning to enter the age of great financial houses. A bank that financed wars, empires, and governments. A bank that was involved in the biggest deals of its time and came to symbolize stability and trust. Its clients included the British royal family. Its name was known in London, New York, Tokyo, and Singapore. It survived world wars, revolutions, economic crises, and countless financial shocks. It seemed that an institution like this could never be destroyed. But sometimes history shatters even the strongest structures. The answer is yes. One person really can destroy a financial empire. And it does not take an army. It does not take billions of dollars. It does not even take years of preparation. Sometimes, all it takes is one person who finds himself in the right place at the right time and makes a few fatal decisions. His name was Nick Leeson, an ordinary bank employee, not a billionaire, not the head of a financial corporation, not a member of the City of London elite, just a trader entrusted with managing operations on the other side of the world. But in 1995, he did what had seemed impossible. He destroyed a bank that had survived wars, revolutions, and economic crisis. A bank that had existed for more than 2 centuries. A bank that had been considered one of the most reliable in the United Kingdom. But it did not survive Nick Leeson. Bankrupt in 1995. Who was Nick Leeson? Nick Leeson was born in 1967 in the United Kingdom into a middle-class family. His family did not belong to the financial elite and had no connection to the banking world. His father worked as a plasterer, an ordinary manual job, hard labor that brought neither much status nor much money. His mother was a housewife who took care of the family and the children. It was a completely ordinary British family. No wealth, no influence, no connections in the world of finance. Nick did not have the advantages that often help people enter the elite circles of the City of London. No connections, no money, no privileges. But he had another weapon: logic. From an early age, Nick showed an aptitude for the exact sciences. At school, he quickly proved that he was good at tasks requiring analysis and calculation. Mathematics came more easily to him than to many of his classmates. His teachers noted that he had a strong analytical mind. He was able to assess different options quickly and find rational solutions. At the same time, he was not some extraordinary prodigy. Nick was not considered a genius. He did not win international Olympiads and was not a famous student. But he had another quality that can sometimes matter even more than talent. He was highly disciplined and ambitious. He understood that he did not have wealthy parents and did not have ready-made opportunities. So the only way to succeed was to work harder than others and move forward step by step. After school, he decided to build a career in finance. But like many young professionals without connections, he started in the most basic and least noticeable positions. His first serious job was at Coates. This was not just any bank. It is one of the oldest private banks in the United Kingdom, serving some of the country's wealthiest clients. Its clients have traditionally included members of the British aristocracy, major entrepreneurs, and even members of the royal family. For a young employee without connections, getting in there was already a serious achievement. However, at Coates, Leeson held a very junior position. He did not manage clients' money and did not make major decisions. His work was technical and routine. He was involved in processing transactions and handling the administrative side of banking operations. But it is often in positions like these that people gain the most important thing: an understanding of how the financial system works from the inside. Leeson watched the processes closely, studied the structure of operations, and gradually built up experience. Later, he moved to Morgan Stanley. That was already a different level. One of the largest investment banks in the world. Working at such an organization meant access to more complex financial operations and international markets. Although he did not hold a senior position there either, this stage helped him better understand how the global financial industry was structured. But his real opportunity came only a few years later. In 1992, he was invited to work at Barings Bank. It was one of the most prestigious banks in the United Kingdom. A bank with more than 2 centuries of history, regarded as part of the financial tradition of the City of London. For a young specialist like Leeson, this was a huge step forward. He was given the opportunity to work within a bank that had participated in the largest international deals and was seen as a symbol of financial stability. But it was from this moment that the story began, a story that would later become one of the most infamous banking collapses in world history. What was Barings Bank? To understand the scale of the catastrophe, it is first necessary to understand what Barings Bank actually was and what place it held in the global financial system. Without that, it is difficult to grasp why its collapse came as such a shock to the markets and to the banking industry as a whole. Barings Bank was founded in 1762. Its founder was Francis Baring, a British entrepreneur and financier of German origin who came to England and succeeded in building one of the most influential financial firms of his time. At first, however, it was not a banking empire at all. In its early years, Barings was a trading company engaged in financing international trade. The company worked with the movement of goods between Europe, America, and other regions of the world. But gradually, its role began to grow. Over time, trade operations became increasingly intertwined with financial services. The company began extending credit, taking part in international deals, and supporting major commercial transactions. In this way, the trading firm gradually evolved into a full-fledged bank. By the 19th century, Barings was already considered one of the largest financial institutions in Europe. Its influence became so significant that a famous phrase emerged in the financial circles of the time. Barings was called the sixth great power of Europe. This was not merely a poetic metaphor. It was a way of emphasizing the bank's enormous economic strength and its influence on international financial affairs. At that time, Europe was traditionally seen as having 5 great powers: United Kingdom of France, Tane Russian Empire, Prussia, Pair Austrian Empire. And Barings' financial influence was considered so great that it was placed on a level with those states. The bank played a major role in the global economy. It financed governments by providing them with large loans. It extended credit for international trade, helping companies and states carry out large-scale transactions. It took part in the biggest financial operations of its time, including the placement of government bonds and the organization of international investments. In effect, Barings was not just a bank. It was one of the centers of the global financial system. Its name was associated with stability, tradition, and vast experience. Over more than 2 centuries of existence, the bank lived through many historic events. It survived economic crises. It survived political change. It survived wars and revolutions that destroyed states and reshaped the world order. But the bank itself kept operating. Even at the end of the 20th century, more than 200 years after its founding, Barings remained a powerful and respected financial institution. It was still active in international markets, served major companies, and worked with investors around the world. Within the financial community, it was regarded as part of London's old banking aristocracy, and that is precisely why the events of the mid-1990s came as such a shock. In 1994, the bank's chairman, Peter Baring, was summing up the year and speaking about the bank's position. He stated confidently, "It has been an excellent year for investment banking. The phrase sounded like a routine, optimistic statement from the head of a major financial institution. At the time, no one could have imagined just how ironic it would sound very soon afterward. Because just 1 year later, everything would change. The bank that had existed for more than 2 centuries, the bank that had financed governments and was seen as a symbol of the British financial system, would cease to exist. Singapore, the management of Barings Bank, noticed the young employee's abilities fairly quickly. Even though Nick Leeson did not hold a particularly senior position, his work stood out from that of other employees. He had a strong understanding of banking operations, paid close attention to detail, and handled financial reporting with confidence. In the banking system, these qualities are especially valued: precision, accuracy, and the ability to spot errors quickly in complex documents. His colleagues noted that Leeson was able to analyze data quickly and understand where problems were arising within the system. For the bank, this was an important quality, especially in international operations, where thousands of transactions are processed every day. That is why management decided to make use of his abilities in the bank's international operations. Leeson was sent to Asia, where Barings was actively expanding its presence in the financial markets. He was first assigned to Hong Kong. There, his task was to sort out problems in the accounting system and help streamline internal processes. The work was demanding and required a high degree of accuracy. He had to analyze documents, review transactions, and correct reporting errors. Leeson handled the task fairly quickly. After that, he was sent to Jakarta. There, Barings was opening a new line of business and needed specialists who could help organize the branch's operations. In Jakarta, Leeson once again worked on internal processes, helping build the accounting system, monitor transactions, and establish administrative procedures. This was typical back-office work, the part of a bank structure that usually remains invisible to clients, yet forms the foundation of the entire financial system. It is the back office that ensures transactions are recorded correctly, that money moves through the system without errors, and that reports correspond to actual operations. Leeson's work in this area was considered exemplary. He demonstrated discipline, accuracy, and a clear understanding of how banking processes functioned. As a result, the bank's management decided to entrust him with a far more serious role. Soon, Leeson received a new position. He was appointed head of derivatives operations on the Singapore International Monetary Exchange, SIMEX. The exchange was located in Singapore and was considered one of the key centers for trading financial instruments in Asia. Futures and other derivatives were traded there. Complex financial instruments whose value depends on the prices of various assets and indices. For the bank, this area was strategically important. Asian markets were growing rapidly in the early 1990s, and Barings wanted to establish a strong position there. For a 28-year-old trader, such an appointment was a huge career leap. Not long before, he had been working in the back office, dealing with administrative matters. Now, he found himself at the center of financial operations on an international exchange. With his new role, he gained access to millions of dollars. He could open market positions, execute trades, and manage major financial operations. In effect, Leeson became the key person responsible for Barings trading on SIMEX. And along with that position, he gained something else: almost complete control over the operations. This was where the bank made its most serious mistake. In a normal banking system, responsibilities are strictly divided. One person executes trades, another person monitors and records those trades. This is a basic principle of financial security. It exists to ensure that no one can conceal mistakes or losses. But in Leeson's case, that system broke down. He was put in charge of 2 critical functions at the same time. Leeson was responsible for trading operations. He executed trades in the market tier, the recording and control of those trades. In other words, exactly what is considered extremely dangerous in the financial system happened. The person making the trades fee was the very same person who was supposed to check and control them. The first trades in Singapore, Nick Leeson began trading futures on the Nikkei 2125 index. This index is the main indicator of the Japanese stock market. It includes Japan's largest companies, industrial firms, banks, and technology corporations. When the index rises, it usually means growing investor confidence and improving market conditions. When it falls, by contrast, it signals problems or instability. In the early 1990s, Nikkei futures were actively traded on international exchanges. For banks and investment companies, this was a convenient instrument. It allowed them to open positions quickly and work with large volumes of capital. But Barings Bank's strategy was based not on speculation, but on arbitrage. Arbitrage is a strategy in which a trader exploits price differences for the same asset in different markets. For example, if a futures contract is priced slightly lower on one exchange and slightly higher on another, the trader buys where the price is lower and simultaneously sells where it is higher. The difference between those prices becomes the profit. This strategy is considered relatively safe because it does not depend on the overall direction of the market. The trader is not trying to predict whether the index will rise or fall. He is simply locking in a small price difference between exchanges. That is exactly what Leeson was supposed to be doing on the Singapore International Monetary Exchange. However, before long, his trading began to go beyond the limits of that cautious strategy. Instead of confining himself to arbitrage operations, Leeson began making far riskier bets. He started opening positions directly tied to market movements. In effect, this meant that he began speculating on the future direction of the index. If he expected the market to rise, he bought futures. If he believed the market would fall, he sold them. Over time, the scale of these operations began to grow. The positions became larger and larger, and the bets increasingly risky. At times, Leeson opened trades in amounts so large that they exceeded the bank's capital, and it was at that point that the situation gradually began to spiral out of control. Account 88888888 one day, Nick Leeson made a losing trade. Situations like this happen quite often in financial markets. Even experienced traders sometimes make the wrong decisions or misjudge the direction of the market. Normally, such mistakes are quickly detected by the internal control system. This trade caused a loss for the bank. The loss itself was not catastrophic. In banking, losses are part of normal trading activity. The main rule is that such mistakes must be recorded in the reports immediately. After that, the bank's management analyzes the situation, understands the cause of the error, and closes the position. This is exactly how the control system in large banks is designed to work, so that problems are identified as early as possible. But this time, something different happened. Instead of recording the loss immediately and reporting it to the head office, Leeson decided to hide the problem. He created a special account. Its number was 88888. At first glance, it looked like an ordinary technical tool. Banking systems do in fact use what are known as error accounts for temporary errors. Such accounts are used when a minor technical inaccuracy arises. For example, when a transaction has been entered incorrectly or when a trade needs to be moved temporarily until the final verification is completed. Normally, money remains in such an account only for a very short time, sometimes a few hours or a few days. After the transaction is checked, it is returned to the normal accounting system. But Leeson began using this account in a completely different way. Account 888888 became the place where he transferred losing trades. Every time an operation resulted in a loss, it simply disappeared from the main reports and ended up in this hidden account. At first, the sums were relatively small, but over time, the losses began to grow. And instead of stopping and admitting the problem, Leeson kept making new trades, hoping to win back the losses. Gradually, account 888888 turned into a huge hidden pit. What had originally been intended as a temporary technical tool became a secret storage place for losses. Leeson simply moved all unsuccessful trades there, and the official reports sent to London no longer included those losses. In those reports, everything looked perfect. The trading appeared profitable. The operations looked successful. The Singapore branch was showing excellent results. The bank's management saw only profits, but the real picture was completely different. While London was receiving reports of gains, ever larger losses were gradually accumulating in the hidden account 8888. Disaster. By 1995, Leeson's positions had become enormous. He had effectively placed the entire bank on a single bet. He believed the market would rise. But on January 17, 1995, something happened that changed everything. An earthquake struck Kobe, Japan. It became one of the most devastating in the country's history. The stock market collapsed. The Nikkei index began to fall sharply. Each drop brought Leeson new losses. But instead of closing his positions, he made even riskier bets. He was trying to win it all back. The losses continued to grow. At first, they were relatively small sums by the standards of a major bank, $100 million. Then the figures began to rise. $300 million. Sometime later, already $500 million. Each new losing trade only made the whole hidden in account 8888 even bigger. But instead of stopping, Leeson kept opening new positions, hoping that the market would turn around and allow him to recover the lost money. Traders do sometimes try to win back their losses by placing new bets on the market. But in this case, the situation was becoming increasingly dangerous. Meanwhile, the bank's management in London still did not understand the scale of what was happening. Reports continued to arrive from Singapore in which the trading appeared successful. The documents showed profits. The operations seemed to be under control, and the results of the Asian division's work even looked impressive. London saw only one picture. The bank was making money. But the reality was completely different. Enormous losses continued to accumulate in the hidden account, and no one at the head office knew about them. With each passing month, the amount grew larger. By early February 1995, the situation had completely spiraled out of control. The market was moving against Leeson's positions, and the losses began to grow even faster. What had once seemed like a temporary problem had turned into a real financial catastrophe. By that point, the total loss had reached $1.4 billion. This was a colossal sum even for a major international bank. And the worst part was that these losses exceeded the bank's entire capital. Escape. On February 23, 1995, Nick Leeson finally realized that the situation had spiraled completely out of control. By that point, the hidden losses had reached such a scale that they could no longer be concealed or offset by new trades. Any further movement in the market would only increase the losses. He understood that sooner or later the bank's management would learn the truth. That day, Leeson came to the office as usual, but instead of continuing his work, he made the decision to leave. On his desk, he left a short note. It contained only a few words. "I'm sorry." It was an almost symbolic phrase, a brief acknowledgement of what had happened. No explanations, no excuses, just an apology. After that, Leeson left the office. He went to the airport, boarded a plane, and fled Singapore, trying to escape the inevitable consequences. At that moment, the bank's management still did not understand the full depth of the problem. But soon, the reality began to emerge. When London started examining the positions of the Singapore division, it became clear that the bank was in a catastrophic situation. The enormous losses hidden in the accounts could not be covered. Just a few days after Leeson's disappearance, Barings Bank officially declared bankruptcy. It came as a genuine shock to the financial world. A bank that had existed for more than 230 years. A bank that had financed governments and was regarded as a symbol of the British financial system suddenly ceased to exist. An entire era had come to an end. 230 years of history were wiped out in just a few days. And the cause of that catastrophe was one man. Finally, once the scale of the losses became known, the fate of Barings Bank was effectively sealed. the bank found itself in a position from which there was no way out. The losses were so enormous that it could not cover them with its own funds. In order to prevent an even more serious financial crisis and protect clients, an emergency decision was made to sell the bank. In the end, Barings was sold for a symbolic price, for just £1. The buyer was the Dutch financial giant ING Group. In reality, this was less a purchase than a rescue operation. The new owner took on the obligations and what remained of the structure of a bank that had existed for more than 2 centuries. Thus ended the history of one of the oldest financial institutions in the United Kingdom. Meanwhile, Nick Leeson tried to hide, but he was soon found. He was arrested and later brought to trial. The court found him guilty of financial crimes connected with the bank's enormous losses. As a result, Leeson was sentenced to 6.5 years in prison. His name quickly became known around the world. Newspapers, financial magazines, and television programs examined what had happened in detail. Nick Leeson became a symbol of one of the biggest financial failures in history. But his story revealed more than just the personal tragedy of one trader and the collapse of an old bank. It demonstrated something far more important. Sometimes the largest financial catastrophes do not happen because of global economic crisis, not because of political upheavals, not because of wars. Sometimes the reason is much simpler: one mistake, one risky bet, and one man